Nifty hovers around the 26,000 mark with small gains since the last session and positive market breadth. Metals and energy gain while financials and auto drag. SEBI issues a consultation paper on mutual fund rules that seeks to enhance transparency on expenses but also trims outgo to brokers. The tightening move spooks stocks of AMCs and other market participants. Copper nears its all-time high, aluminium scales to a 3-year high and zinc trades close to its 10-month high as optimism over a US-China trade deal coupled with supply concerns give bulls reason for cheer. Indian metal stocks to rally. US President Donald Trump says he's going to do a trade deal with India, adding that he has great respect for PM Modi. The remark sparks hope of a deal soon, even as positive indications in the past haven't translated into anything material yet. All eyes will be on the Federal Reserve's rate outcome, which is expected later tonight. A CNBC survey of respondents expect a rate cut in this meeting, with majority of respondents expecting rate cut also in December. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra and we are tracking market moves on fresh day of the expiry. Right now, we are comfortably above that 26,000 mark. The Nifty is seeing gains of around 140 points as we speak. It has come off slightly, but there's of course nothing to complain about. Swiftly seeing that recovery from the lows of the day. Across the board, we are seeing major moves which are coming by. The mid-cap index is up 0.4% as we speak. The banks are underperforming today, but we do have the energy space which is doing really well. We have the metal index, which is one of the top gainers, 1.7% higher there. Oil and gas names, CPSE names, all of them are on our radar because they're buzzing on the upside. What's not doing so well, we have some short covering, some long unwinding that we are seeing in the PSU banking names. Small cap index too in the red today, but the advance decline ratio, that is in favor of the advances as we speak. But that's about the market moves. There's a lot happening underneath as well. And one of them is the SEBI paper, a consultation paper, which is coming on expenses charged by AMCs to mutual fund investors. And that's the big story that we are tracking for you. Basically, it is done to ensure there's more transparency, which would come by for all the expenses which are charged by AMCs. They have restructured the expense ratio. The reduction is on the screen for you. For open-ended scheme, it is proposed to reduce it by 15 basis points. For closed-ended scheme, it is around 25 basis points. For equity-oriented, expense ratio reduction by 1% to 1%, and other schemes, it is 2.8%. Now, do remember, they've also added that they will remove additional expense of 0.5% or 5 basis points on the entire AUM, which was 20 basis points earlier. From 2018, it became 5 basis points. In terms of the brokerage fee cap, basically the brokerage that mutual funds pay to brokers for buying those stocks, for the cash transactions, it's proposed to reduce from 12 basis points to 2 basis points. For derivatives, it's been proposed to reduce it from 5 basis points to 1 basis points. Additionally, they add fund houses that venture into non-mutual fund management activities. That has to be a separate business altogether. The employees have to be different. There should not be any overlap in these two activities. They say that STT, GST, stamp duty, all of them will remain outside the purview of total expense ratio. There will be a different column for this. This is done to improve transparency and also reduce hidden costs. Additionally, the proposal is performance-linked expense ratio for mutual funds, which will basically align fund managers' performance to what they are charging the investors. So better performance, higher charges, not so good performance, lower charges to be borne by the investors. Detailed performance, of course, because of this performance-linked incentive, will be taken up later. This proposal also marks a departure from 2023 proposal that SEBI had put out, where all of these expenses were to come under one head, but the industry did not agree with it so much. So this as well is a proposal right now. We have not received any final agreement on this. 17 November is the last date, so we'll have to see which way things go. But on the back of this, because it would mean lower income for some of these AMCs and brokerage houses, all these stocks are lower in trade today. So these stocks are on our radar. That's the big story that we are tracking for now. But earlier today, we spoke to Ashish Somaiya, CEO at White Oak Capital AMC, and Sandeep Bagla, who is the CEO of Trust Mutual Fund, about the proposal. Listen into what they had to say.
if you think of brokerage or whatever is paid to brokers as 12 bips, it's not entirely paid to brokers because there are components like, exchange fees and stamp duties and STT and so many things out there. So it's not like 12 becoming 2. It will be more like, say, if it, say as per the regulatory paper, if it was 10, it might become like 4, 5, 6 or something like that. It will settle at, because everything doesn't go to the broker. What the broker bills, there are further components into it which go to exchange and stamp duty and all those kinds of things. But yes, that will benefit investors. For the investor, I think the TERs will come down even after making all these adjustments of removing from TER, adding plus, etc. Net TER will go down. So the industry has to figure out how to absorb that. I think, all told, if you really ask me, the industry has to contend with figuring out how to manage this. I think it will be 10, 12 basis points, not more, which is what the knock will be. But 10, 12 basis points is a significant number. And yes, within that, clearly, we have to arrive at an equation. Now, different players will have different equation with the channel partners, but it will have to be split. Because ultimately, if let us say on an average 60% is going to the channel partner and 40% is going to the AMC in terms of retention, then it's only fair that even the knock is split accordingly. So I think that will be the bare minimum. So ultimately, when you ask about AMCs, it will boil down to low single-digit basis points of impact.
The impact will not be as much as the top line suggests. And it depends on how much distributor fees are also compressed by the AMCs. So in the short run, yes, there would be an impact in terms of lower fees when this goes through. But over a small to medium period of time, I think it will adjust. And if, looking at the growth at which the mutual fund industry is growing, I think we will see it as a small blip in the longer term.
Okay, we also spoke to Prateek Gupta, CEO and co-head at Kotak Securities, on the SEBI's draft proposal. Let's listen into what he had to say.
Obviously, the impact would be quite negative for partly the mutual fund industry and also the distributors and brokers who service or who are very heavily dependent on the mutual fund industry. But I think it will be very, very negative for some of the smaller brokers and also for some of the smaller mutual funds in particular. And even the larger funds and distributors, they will be impacted to some extent. And I think you will start seeing resources being directed more towards, away from mutual funds towards other categories like PMSs, AIFs, or foreign portfolio investors. It's a free market, and brokers charge whatever. Even when we service FIIs, we have different rates for different customers depending on how much servicing they're taking from us, etc. So the best thing in my view is encourage competition, let free market forces prevail.
All right, that's the big story that we are tracking today. The other big story is Indian refiners scaling back from Russian oil purchases on the back of international sanctions. But what could the impact be for Indian economy and refiners? Axis Capital's Neelkant Mishra spoke to CNBC's Manisha Tank on the issue. Listen in to what he had to say.
Exact advantage or the relative advantage that India had from buying Russian oil had actually shrunk to almost nothing over the past 1 year. So the gap between Brent and Urals was $30 a barrel in 2022 when the first sanctions were imposed. It had actually shrunk to $4 or $5 a barrel over the past 12 months. And once you adjust for the higher cost of insurance and freight, the landed price advantage was like $2 or something. So it's not that India was benefiting greatly. Now we are at a stage where oil markets are significantly oversupplied. This is part of the reason why you're saying that Brent is back to 64. I mean, it was 60, 61 when the sanctions on Lukoil and Rosneft were announced. So there is enough oil in the world. India, you're absolutely right, imports 85% plus of its oil needs, more than half of its dense energy needs, and these are things that India needs to work on. But at this stage, from a cost perspective, remember last year, the average Indian mix, which is closer to Brent, the prices were $10 a barrel higher. So as of now, it's not a drag on the economy. I think diversification, and remember, Indian refineries are some of the most complex in the world. Their ability to handle all kinds of crude is proven. And therefore, I don't see any India-specific reasons to worry about the sanctions affecting the Indian economy.
All right, that's the opinion coming in from Neelkhand Mishra on Russian imports and the impact it could have on the Indian economy. Take a short break now. On the other side, we'll get you highlights from CNBC's Fed survey as the Fed's interest monetary policy decision is due later today. Welcome back. You're still tuned into Business Lunch. The big story, US President Donald Trump is in South Korea for the final leg of his Asia tour. At the APEC CEO Summit, he spoke about potential trade deals with India and China. CNBC's Cherry Kang gets us the latest highlights.
U.S. President Donald Trump has hyped the prospect of a U.S.-China trade deal as it kicks off the last leg of his Asia tour. Speaking at the APEC CEO Summit on Wednesday in Gyeongju, South Korea, he said he expects a great deal with China. He, in fact, gave more details on his way here, floating the possibility of lowering fentanyl-related tariffs on China and also discussing Blackwell chips with his Chinese counterpart Xi Jinping. The bilateral between the U.S. and China is expected to happen tomorrow on Thursday, which is going to be the centerpiece for this pivotal week for global markets. It wasn't just China, by the way. He said he expects a great trade deal with India and that U.S. is close to finalizing one with South Korea. He definitely continued to drive this idea of an American manufacturing boom, really touting relationship with countries like South Korea, which is, of course, a shipmaking and shipbuilding powerhouse in the region.
So I'm doing a trade deal with India, and I have great respect and love. As you know, for Prime Minister Modi, we have a great relationship. Likewise, President Xi of China is coming tomorrow here, and we're going to be, I hope, making a deal. I think we're going to have a deal. I think it'll be a good deal for both. And that's really a great result. You know, that's better than fighting and going through all sorts of problems and, you know, no reason for it. I think it's going to be a great deal for both.
Okay, the big cue for investors today would be the Federal Reserve's interest rate decision. Remember, the Fed is making this time's decision amid an ongoing government shutdown in the U.S. CNBC's Steve Leisman is here with a survey on the Fed's rate cut path.
Respondents to the October CNBC Fed survey see a rate cut on the way from this meeting, the next meeting in December, and possibly one in January, despite continuing worries about inflation, tariffs, and the government shutdown, in which, according to one respondent, the Fed is flying blind. Take a look at the numbers here. 92% say the Fed will cut in December. Of course, only 66% think the Fed should cut. There's concern about inflation and the other things I mentioned before. Additional cuts coming, 100 basis points. That includes this meeting, December, maybe January, all the way through 2026, bringing the funds rate down to, drum roll, 3.2%. So just another 100 to go from where we are right now. Richard Bernstein, CEO of Richard Bernstein Advisors, tells us that because of inflation and a surging stock market, quote, in more normal times, there's no way the Fed would be cutting rates here. Inflation is seen remaining above the Fed's 2% target, 3% this year, 2.8 by 2026, 2.6 by 2027. That's around where the Fed's target is because CPI runs a little hotter than the PCE. Tariffs remaining the #1 threat to the expansion, according to the survey. But 63% say that the effect on inflation has been less than they expected. 37% say in line. But why? 48%, unfortunately, say the impact has been muted so far because the full effects of tariffs have not been passed along yet. That speaks to perhaps further increases in prices. 30% say companies are eating those tariffs, maybe more pass along there. 13% say there have been offsets to tariffs by declines in other categories of the CPI. Several Fed officials, along with survey respondents, have concerns about cutting too much with inflation still above target and without the data we need to know if we're doing the right thing.
And of course, you can tune into CNBC TV 18 for all the updates when it comes to Fed outcome on the rate cuts. Moving on, fears of AI are taking over jobs and it is on the rise. However, Jensen Huang, who is the CEO of the AI chip darling NVIDIA, thinks otherwise. Listen into his statements from the NVIDIA GTC event.
I think this idea that AI is going to take jobs is going to change everyone's job. That's for sure. But I think it's going to make companies more productive. We're more productive today because of AI. We're hiring more people.
Okay, with that, we'll do one thing. We'll slip into a short break. As we do that, here's a quick note for our viewers. If you would like to access expert-driven insights and actionable chart patterns, simply scan the QR code on your screen and subscribe to Money Control Super Pro and get daily expert calls, actionable charts, and insights to power your investing decisions. Plus, this festive season, there's more reason to celebrate. 10 lucky subscribers every day win 1 gram of gold. So do not wait. Scan, subscribe, and make your portfolio shine brighter with Super Pro. Welcome back. You're still tuned into Business Lunch. A lot of earnings which are due today. Let's talk about the big one. L&T is the one to watch out for. Vivek is joining us with what the street is expecting this time around. Vivek?
Well, that's right. So capital goods and infra major L&T will declare its Q2 results. It's been a very eventful quarter for the company. A lot of order wins, a lot of annual positions, especially as far as West Asia is concerned. And more importantly, the divestment of the Hyderabad asset was something that the company announced. Now, looking at the numbers themselves, consolidated revenues, including the services business, is seen higher by close to 13.5%. EBITDA is seen higher by close to 10%. The EBITDA margin is expected to soften on a year-on-year basis, close to 40 basis points, and profitability seen closer to the 4,000 crore mark. Now, as per JM Financial, they estimate that the core revenue, which excludes the X-services as well as the X-development, that is the realty business, they expect that particular business to grow close to 20%. Core EBITDA margin, the number that analysts will be watching very closely, is expected at 7.9%. First half order inflows expected to be very, very strong. Close to 2 lakh crore. Now, one important thing to keep an eye out for L&T, remember the order inflow guidance for FY26 is at 10% growth, but company is set to surpass that quite comfortably. So all eyes will be on whether the company goes ahead and upgrades its order inflow guidance for FY26. Consolidated order book, remember, end of last quarter crossed the 6 lakh crore mark. So all eyes will be on the side of order inflows that the company has received, especially from West Asia.
Yes, this is the big stock to keep on your radar. Thank you so much, Vivek, for joining us. Let's move on. President Draupadi Murmu flew a sortie in an Indian Air Force Rafale jet at the Air Force Station in Haryana's Ambala. She was given a guard of honor prior to her Rafale sortie. This is President Murmu's second flight in a combat aircraft following her 2023 sortie in a Sukhoi 30 MKI at Tezpur Air Force Station in Assam. She is also the third president and the second woman president to undertake such a sortie after former presidents APJ Abdul Kalam and Pratibha Patil. And the Japan Mobility Show is underway in Tokyo, and car maker Honda has unveiled futuristic SUV models which could soon find their way to the Indian market. Take a look.
Now, what you see in front of me is the Honda Zero SUV. You've seen this earlier at the CES. This is a very high-end, top-spec EV a Honda SUV might look like from the future. As you can see, the design is very modern, minimalistic, boxy. It has that kind of shape that you want from a big, luxurious SUV. Now, let me quickly show you what the side is. It's got that flat, very practical shape. The ground clearance, as you'll notice, is not very much like most modern EVs. It's more designed for streamlining and for better range. I'll quickly show you the behind, where there is quite an interesting feature. You notice this flat, very station wagon-like paneling. It gives you a lot of space. I especially like how this is done, and the lighting element is really quite smartly done. Now this is what it looks like on the inside. As you will see, it's got that very modern, minimalistic, very striking look. It has that yoke kind of steering setup, the very, very minimal kind of instrument cluster. And I really like how the screen has been done up. You have that fully flat kind of screen. It merges into each other. I'm sure it's got a lot of screen real estate. And as you notice, you don't have wing mirrors. You have cameras even for the rear view mirror. And right there is the center console.
Okay, all right. With that, we'll do one thing. We'll take your leave on this edition of Business Lunch with the news that the Nifty is up 140 points and the mid-cap index up to 60. We'll take your leave. Mid-cap radar comes up next with all the market action.